Welcome to our quarterly bulletin. My name is Pat Magadla and I'm the head of distribution at Equilibrium Investment Management. It is my pleasure to be hosting you this morning. Before we commence, some housekeeping. We've applied for Continuous Professional Development or CPD points. It is important to please watch the full session and add your ID number to the CPD section so we can verify your attendance. You may also view this event on this platform at any time until the end of August 2024 and receive your CPD points. Our operations team will email you your CPD certificates during the month of September. Please also feel free to ask any questions in the Q&A section, and our speakers will either answer them live or get back to you after the event. You can find more information about each of our speakers under the Speaker tab, located at the top menu bar, or if you scroll down. Additionally, if you'd like to download the presentation being shared today, look for the PDF download link. Okay, let's kick off the session. We are just over halfway through the year, so I think it's actually an opportune time to reflect on the first half of the year and look at investment opportunities that lie ahead. First is our economist, Sanisha Packirisamy, who will share with us some key economic insights, particularly around the shifting global axis of influence.
Thank you, Pat, and thank you for joining us. In a year witnessing an unprecedented number of general elections, the surge in protectionist measures, social unrest, and geopolitical turmoil has intensified. These conditions are enabling populist movements to solidify their foothold. Economic woes like rising inflation, slowing growth have magnified long-standing grievances, particularly distrust in institutions that was simmering even before the COVID-19 pandemic. While immigration, race, and religion will remain focal points of populist agendas, the current socioeconomic strain, worsened by high living costs due to conflicts in Ukraine and the Middle East, have heightened dissatisfaction with the incumbent governments. This year's extensive election schedule has already shown a continued populist trend, with similar shifts likely in upcoming elections. There's been a global departure from traditional centrist politics as fringe voters become more hostile to democracy. The Economist publication argues that this leaves the moderate center lacking conviction. Radical and populist leaders have filled this gap, bringing passion and intensity that have shifted the political landscape. They have successfully lured disenfranchised voters seeking an alternative to long dominant centrist parties. While centrist parties struggle to counter the fear and anger that dominate the political discourse today, politicians on the extremes promise simpler solutions to more complex problems. Populist leaders may win public favor, but their rule often results in increased gender, ethnic, and income inequality. The hierarchical nature of populist parties, which prioritizes charismatic leaders over strong organizations, makes them vulnerable to foreign interference. Weak legislative oversight allows executives to bypass constraints, impacting both formal institutions like judiciaries and informal checks such as the media and civil society. In its most extreme form, this concentration of power facilitates severe abuses, targeting opponents and undermining democratic principles. This trend has even extended to some of the wealthiest democracies. For decades, Western political systems have featured dominant center-left and center-right parties or coalitions that supported the basic tenets of liberal democracy, while differing on specific issues. The main divide has been economic, with center-left parties favoring more government spending and trade union alliances, and center-right parties leaning towards market-oriented, private sector-friendly policies. Yet, recent elections progressively reveal that this long-standing center-left and center-right dominance is losing its grip. The rise of fringe parties has carried into 2024, with populist movements now making significant inroads into developed markets, regions historically known for their established political norms, strong institutions, and stable macroeconomic policies. This is likely due to the global cost of living crisis, which was initially triggered by the COVID-19 pandemic. Now, the Economist review of past pandemics indicates that they typically result in increased inequality. 5 years after a pandemic begins, Gini coefficients usually stay around 1.25% higher than pre-crisis levels. Now, true to this pattern, the COVID-19 pandemic led to greater income inequality, fueling the rise of populist movements as voters lost patience with existing governments. With the global axis of political influence shifting, these political changes could result in policies that hinder exports and drive inflation higher. This is likely to be accompanied by increased market volatility as these risks draw more attention from market participants. In its most extreme form, populism can endanger democracy, deepen social divisions, and undermine trust in government. In the United States and Europe, traditionally seen as bastions of democracy, the upcoming year is shaping up to be particularly risky politically. The post-World War II order that has supported the West for 8 decades could be seriously threatened if former President Donald Trump wins a second term this November. Risks include widespread tariffs, a shift towards protectionism, a state that is more politicized, the withdrawal of support for Ukraine, and a weakening of NATO. The Bank of America Merrill Lynch Fund Managers Survey indicates record concerns among global fund managers about government debt. Further tax cuts could imperil America's fiscal health, especially if Republicans secure a sweeping victory in the White House and in both houses of Congress. If Trump's trade policies are enacted, growth in many emerging markets, which increasingly rely on an open world, will be negatively affected. The past decade in American politics has been marked by a decline in political tolerance and a surge in social media disinformation. The partisan divide between Democrats and Republicans has grown wider and even more venomous, with an increasing willingness to use physical force. Incidents like the January 6th attack on the US Capitol in 2021 highlight this trend. More recently, Donald Trump survived an apparent assassination attempt at a rally in Pennsylvania. A June survey from the University of Chicago found that 10% of American adults support violence against Trump. This support is rooted in a distrust of the establishment, and conspiracy theories spread on social media. The advances of right-wing parties in the European parliamentary elections underscore the rising tide of populism. Across Europe's major nations, centrist parties are being outmaneuvered by their far-right counterparts. In Germany, the center-left Social Democratic Party, currently leading the federal coalition, came in third, trailing both the center-right Christian Democrats and the far-right Alternative for Germany. While it was the far right that initially harnessed the backlash against free market capitalism and hyper-globalization post the 2008 financial crisis, leftist parties are now better positioned, as seen in France. President Emmanuel Macron's centrist coalition was decisively defeated in the first round of parliamentary elections by Marine Le Pen's far-right National Rally. However, the far left gained ground in the second round by uniting before the vote. France's weak culture of political compromise faces a test, as voters have elected a fragmented assembly divided into 3 blocs with none holding a majority. Macron has 3 main options to resolve the hung parliament: forming a coalition government with pro-European parties, establishing a minority government with the left-wing alliance, or appointing a technocratic government until another election can be held. While technocrat governments can provide stable governance by focusing on pragmatic solutions rather than partisan interests, it can also carry risks for the functioning of a democracy. In the United Kingdom, the new Prime Minister Keir Starmer of the Labour Party projects an image of a more stable government. British foreign policy pillars are likely to be upheld, including support for Ukraine and the Anglo-American relationship. Nonetheless, we expect more activism in other areas. Labour aims to cultivate warmer ties with the European Union concerning things like food trade, education and security without actually rejoining the EU. They also plan to enhance relations with the Global South while reviewing consumer goods trade with China. However, as the New York Times highlights, Labour's landslide win wasn't a straightforward shift in the political landscape, with lower voter turnout and Labour garnering 17,000 fewer votes than they did in 2019, which gave the populist right a notable foothold. Latin America's populist resurgence and recent Asian electoral shifts reflect global democratic changes. However, success stories of centrism and united oppositions challenging illiberal populism offer hope. Take Poland. A diverse coalition ousted right-wing populists, restoring democratic norms. This could set a precedent for other nations grappling with authoritarian leadership, like Hungary or Turkey. Greece's moderate prime minister reversed radical left populist rule, a testament to the resilience of centrist governance and global political shifts. Moreover, Hungary's recent European parliamentary setbacks for Viktor Orbán hint at shifting tides. Despite maintaining a strong grip for 14 years, the rise of a new centre-right opposition party poses a credible challenge in the upcoming 2026 national elections. The resurgence of populism in Latin America reflects wider shifts in democratic governance. Claudia Sheinbaum's landslide victory in Mexico, backed by the populist legacy of former President López Obrador, solidified the left's dominance. Meanwhile, Argentina faced political upheaval with the election of right-wing leader Javier Milei as president last November. In Venezuela, opposition leader Maria Corina Machado was barred from appearing on the presidential ballot, but she has managed to unite a long-fractured opposition coalition that once ostracized her. What's more is that she's built a powerful, energized citizen movement that hasn't been witnessed since the 1990s. Across in Asia, India's Narendra Modi faced political shifts as his Bharatiya Janata Party lost its parliamentary majority when it failed to achieve a predicted electoral landslide. His party now requires coalition agreements with political rivals to maintain governance under a centre-right framework. A strong showing of support for the opposition has put a stop to the slide towards authoritarianism, despite official media limiting the amount of airtime opposition leaders received. The Guardian has noted escalating tensions between the United States and China, suggesting that unlike the Cold War, today's conflict is influenced by deep economic ties and the emergence of middle powers like Russia, India, Turkey, Saudi Arabia, and even Brazil. These nations often balance economic relations with China alongside security partnerships with the US. While China delights in the grimness of America's political predicament, both Democrats and Republicans harbor skepticism about China's ascent, viewing it as a challenge to US dominance and the global order. While both Biden and Trump advocate tariffs on Chinese goods, Trump's foreign policy remains unpredictable. Coming back home, the 2024 national elections represented a turning point in South Africa's political landscape. For the first time, the African National Congress, or ANC, did not secure a decisive majority, with its share of National Assembly seats reducing to 40% from a peak of 70% in 2004. This outcome highlights deep-seated public concerns about the effectiveness of our democratic system, which has often fallen short of expectations. South Africa's economic challenges since the global financial crisis have deepened unemployment and inequality. Despite the ANC's ambitious programs to enhance healthcare, transport and utilities access, the quality of these services has deteriorated significantly. Corruption, patronage, and the blending of state and party roles have undermined key institutions. Failures in sectors like ports and railways, along with the collapse of state-run services, have further stifled growth, reduced tax revenues, and compelled repeated bailouts, imperiling fiscal consolidation and debt management. Democracy's ability to promote economic equality is being questioned in South Africa. Persistent inequality has heightened public disillusionment with the political system and threatens to corrode social unity. Dissatisfaction with the ANC's 30-year grip on power, South Africans are now pursuing cooperative approaches to tackle national issues. The 2024 elections saw the ANC lose majority control in 4 provincial legislatures, including vital economic hubs like Gauteng, KwaZulu-Natal, and the Western Cape, leading to the formation of a coalition government with 9 other parties. In South Africa, widespread dissatisfaction due to government's failure to address socioeconomic inequalities and fulfill promises of inclusive prosperity has fueled a surge in populist support, as evidenced by the increased support for parties like the Cape Coloured Congress and the Patriotic Alliance. Leaders such as Julius Malema of the Economic Freedom Fighters and Jacob Zuma of the Mkhonto weSizwe Party have capitalized on these grievances, offering transformative solutions to disillusioned voters. The Progressive Caucus, which includes the EFF and the MK Party amongst others, opposing the Government of National Unity, provides essential political competition to prevent economic benefits from favoring only the elite. However, divisive racial politics could perpetuate historical, social, and economic divisions instead of bridging them. Moreover, calls to abandon the Constitution will not resolve South Africa's core issues of poverty and inequality, and instead risk undermining the country's constitutional foundations. In our view, the new cabinet and parliamentary working committees have resulted in broadly positive changes, including continuity in the finance and electricity ministries. With the disbanding of the Department of Public Enterprises, state-owned entities will temporarily report directly to the presidency, allowing for continued reforms at Eskom and Transnet, which are crucial to revitalizing growth in South Africa. We anticipate that business and consumer confidence will rise in hopes of continued structural reforms, leading to a better economic path as accountability and governance improve and as policy and reform continuity prevail. Nevertheless, the path ahead remains politically challenging and depends on productive conflict resolution methods to resolve disputes between partners participating in the Government of National Unity to positively impact government's ability to deliver on socio-economic reforms. South Africa has now entered a phase where collective decision-making is crucial for effective governance. As such, the stability of the incoming government will hinge on shared goals, equitable power distribution, and the political maturity of the represented parties in Parliament. I thank you for your time.
Thank you, Sanisha, for sharing with us the dynamic macro-environmental shifts and helping us make sense of it all. Next, you're in for a real treat with our next interaction. We're now going to move to our SA-listed property panel discussion, moderated by Rupert Gersing, a portfolio manager at Equilibrium. Rupert is joined by our guests from 2 esteemed specialist property houses that have the singular focus on listed property asset class. Our panelists will discuss the SA-listed property fundamentals and address the question whether it's time to start allocating to the sector. So this on the back of the US Fed signaling the end of the rate hiking cycle, the imminent rate cuts locally, load shedding that's finally abated, and a growing e-commerce theme. The question is, how has all of this impacted the property sector? Over to you, Rupert, and your guests.
Good day. It's my pleasure to introduce Mvula Seroto, the Director and Portfolio Manager at Catalyst Fund Managers. Mvula. Mvula has a career in the property sector that spans over a decade. He's a chartered accountant and a CFA charter holder. Mvula is joined this morning on the panel by Sesfikile Property Investment Director and Portfolio Manager Evan Jankelowitz. Morning, Evan. Evan is also a CFA charter holder and he has had a career in asset management spanning over 20 years. Mvula, I'll start with you. From a local perspective, the property sector has faced many headwinds, including load shedding, COVID, working from home policies, and high interest rates. I would, however, like to kick off with a valuation comparison and bring bonds into the discussion. Yields are still very attractive. How has higher bond yields impacted appeal to the listed property sector, and at what point do you foresee a shift to property?
Yeah, thank you for the question. Look, it's a loaded question, but I think it's important as you put context to actually the conversation. As you mentioned earlier on, the property sector has been facing many challenges, and one consideration that you bring to the picture is obviously the yield relative to bond yields. I think it's important to actually contextualize the property sector. Evolution of the SA property sector has actually shifted for the past, I'd say, 8 to 10 years. Around 2015, most of our assets were purely in South Africa, and obviously the yield comparison to the SA 10-year bond became a relevant proxy for a lot of asset managers. Where we are today, a lot of our assets are actually sitting offshore. So we'd argue the yield comparison to the SA 10-year government bond is actually not the relevant metric, but still relevant as to the asset allocation question and conversation. So to answer your question about where we are in terms of relative, our yields on the SA property front are actually slightly lower than the current 10-year bond. But at the beginning of the year, our current 10-year bond was around 11%. We saw the spike given the uncertainty of obviously the politics and who's going to be governing the country. We saw a spike in the 10-year government bond to around 12.25, which obviously had an impact on asset classes. The risk premium was high, and with that obviously made the fixed income proxy more attractive relative to other asset classes. Where we are today, the 10-year government bond has actually re-rated back to around the 11s, of which property asset has been a beneficiary of that. I mean, our capital returns year to date have actually contributed materially to the sector's total returns. So our yield on the property is around 9.5, which again, you'd argue is not really compelling versus the 10-year government bond yield. But I would argue again to my earlier point that a lot of those assets within the SA property mix are sitting offshore. So if you were to just look at pure focus SA property companies, the yield around those companies are actually closer to the 10%. But with that, I mean, you'd argue the 10-year bond is actually not growing. So it's a fixed coupon of which property income earning streams are actually growing. So the 10-year, I mean, the SA property listed yield of around 10%, we think will be growing around 2 to 3% over the next 2 to 3 years. So again, in terms of valuations, we think it's probably relatively fair relative to other asset classes. I don't know, Evan, if you've got anything to add over and above that.
I'm going to add when I'm asked that particular question. I've got a lot in store.
Thanks, Evan. On that, staying with headwinds, investors are still concerned about changing work policies in a post-COVID world and return to office life as we once knew it. But how bad is it really in the office sector? Has vacancy rates improved, and are there perhaps specific areas and regions where you are seeing strong demand?
You must just take it into context. I can see you've been listening to a lot of global news where there's a high prevalence of work from home. We are not the US coastal cities where the kind of work from home is, call it circa 70%. In South Africa, your work from home is significantly lower. And there are many factors to that. Our employment environment is not as strong as that of, for example, of the US. So people or the employees don't have as much negotiation or negotiating capacity. Also, it's because of the likes of the access to electricity, the access to Wi-Fi. Not everyone has that at their house. So working from home is not always an option. So if you look at office, you've seen a lot of return to the office, and it's getting stronger and stronger. If you look at the vacancies in the office space, specifically in the prime and the A grade, which is the most exposed, or the listed property benchmark is most exposed to those regions, you've seen the vacancies compress by circa 2% to around about 8.5% in the prime grade office. So office is getting stronger, still not strong, but a lot stronger than it was. So work from home is really not a headwind that a lot of guys were expecting. So I'm actually quite bullish on office off a very low base, take it in that context. And yes, going forward, I think we'll see a lot more return to the office. And I'm quite excited on the prospects of office going forward.
Thank you, Evan. Mvula, question for you. From an asset allocation perspective, there certainly has been a lot to be excited about in the property space in recent times, with it being the best performing asset class over the last 12 months. So turning our attention to the positives, if we were to drill down to sector level, which of the sectors do you find most appealing, and how are you positioning your portfolio to capitalize on those opportunities?
Yeah, thank you for the question. I mean, again, it's quite pleasing that the SA listed property sector has actually rebounded and outperformed a lot of asset classes, at least in the short term. And a lot of that has been on the back of what you are, I guess, alluding to, the positives that are facing the sector. Evan has mentioned we are coming from a low base. So starting with offices, for instance, we've seen a slight improvement from the office subsector. I mean, it's coming off a high base of vacancies across the nation. I'll talk of pockets of offices, vacancies in Cape Town, for instance, that are materially low, high single digits relative to, I guess, the nation. And more importantly, if you look at the office national vacancy levels, materially high, but when you look within the SA listed space, where you actually get the better quality assets, your P and A grades, the office vacancy there is slightly lower than the national average. So we think offices are actually rebounding from a low base. Across the other subsectors, we like retail. We are overweight retail subsector with the likes of your iProp and Vukiles. And the reason for that is that firstly, valuations are supportive of that. We like the rebound, obviously, from, like you mentioned earlier, on COVID lows, where retail sales have rebounded nice and strongly, and vacancies have come in. And I think the one important thing that maybe a lot of, I guess, commentators are not aware of or haven't actually fully digested into the numbers is that we think this two-pot retirement pension fund system that's coming into play early September could be actually a boost to that subsector. I mean, commentary has come in that obviously a lot of, call it individuals or men on the street, will potentially be tapping into the retirements. And firstly, to look to pay down debt, but more importantly, to alleviate any stresses, which would allow obviously improved disposable income. And we think a lot of that will be flowing into retail sales, which will be supportive, at least in the short term, for retail sales. So we like that subsector. Industrial has been a dominant and defensive subsector, I guess, for the past 4 to 5 years. We think that will continue to be resilient. And then more importantly, residential, which is also quite small within the sector, has also come off a low base, and we've seen improving occupancies and increased rental growth. So net, I'd argue a lot of the subsectors within our universe are actually showing some improvement. I mean, if you were to ask me the question last year or 12 months back, we'd still be saying we are concerned about the office subsector, but like as Evan has alluded to earlier, I mean, we think offices are coming off a low base, and with prospects of potentially GDP growth coming into the forefront, we think that will obviously bode well for economic growth and should lead obviously to office demand increasing.
Speaking of the office sector, Evan, or the retail sector, apologies. The sector has been affected by e-commerce and the growing online shopping trend. Have shopping malls seen foot traffic improve in SA, or are consumers preferring letting their fingers do the walking or their phones? And what are the impact on vacancies, rentals, and specifically rental escalations?
Once again, you've been listening too much offshore news. Yes, e-commerce is very prevalent, but mostly global. So there's no doubt we saw that spike or the impact of e-commerce through COVID, and it has come off those highs, but it's sticky in most environments. But in South Africa, once again, our environment is not as conducive to e-commerce as the likes of the developing economies, even the likes of Brazil. Their e-commerce penetration is over twice that of South Africa. So we haven't seen the impact to the same degree as we've seen globally. But what we saw after COVID, there was a lot of revenge spend, and people are communal beings. They want to be seen, they want to see people, they want to feel, they want to interact. So you've seen a lot of people come through to the shopping center where they could very easily shop online. And I'm talking about the more affluent areas where going onto a take lot is very easy. You know, Checkers 60, very easy, and a lot of people do it, but they still want to go to the shopping centers. They still want to see and touch and feel and be part of a communal environment. So we've actually seen a strong growth in retail sales and occupancies as well. Another thing to point on is that through the very traumatic, call it decade, that we've seen in SA Inc. and in property in particular, with higher rates, with COVID, a very weak economy, you've seen very little supply coming through. And that is a great story. So even though that the demand has picked up, but very slowly, there's been no supply. And that's boded very well for retail as well as other asset classes.
If I may add, I think, it's an important point you make about e-commerce, but if you look at South Africa, the developing countries, I think the infrastructure is not supportive of, growth in e-commerce versus your developed. If you talk about township malls and the like, we'd argue the infrastructure is not there to actually feed into e-commerce penetration for all these retailers. So I think that's one of the reasons that we've seen a low penetration relative to your developed markets.
Thanks. Mvula, another one for you. We have alluded to it briefly already, but property has always been an attractive asset class due to its income component and capital growth potential. What is the dividend yield at present? We did discuss it briefly, as I mentioned, and can you perhaps also elaborate on the long-term return outlooks for the asset class?
Yeah, sure. Look, I think, again, important to contextualize total returns of listed property over time. Historically, listed property has delivered around 13% annualized returns. And of that returns, 2/3 of it has actually come from the income component. So we think it's an important characteristic that obviously a lot of asset allocators look at it. And you mentioned earlier with your question about bond yields and the like, it's a proxy to other asset classes. So on the dividend yield, I think it's important to remember that there's been a move from 100% payouts to at least, I think, between 75 to 80% across the sector. So our dividend yields have been lower on the back of that, but obviously that's actually helped improve the sustainability of earnings and balance sheets within the sector. So we see it as a net positive, but the yield is sub 9% as we sit, and obviously that's on the back of a re-rate that we saw over the last 12 months. And in terms of total returns, we think listed property will be able to deliver around 12 to 14% over 5 years within our models, and obviously that is annualized. So given the short-term volatility and uncertainty of macro inputs, we think that could obviously play on your total return component. But in the short to medium term, year to date, we're actually sitting at around 12 to 13% total returns for 2024. And we think the returns from here on will be subdued going into the back end of the year. But again, catalysts that could support a further re-rate within the sector, we think one, obviously interest rate cuts, both locally and globally. The SARB has actually alluded to potentially looking at cutting interest rates in the back end of the year, and we think that would be supportive, firstly for earnings for all the listed companies, more importantly for a re-rate on a capital level for the overall companies within the universe.
Evan, with property falling out of favor and being almost the stepchild from an asset allocation perspective in recent years, we've seen exposure to the asset class in multi-asset or balanced type of funds reducing drastically. What are the numbers looking like currently, high level, and where do you think the ideal exposure is?
It's a great question. Whenever people speak about historic performance, as an indicator of future performance, it's like driving down the highway by looking in your rearview mirror. It's not rational. The truth of the matter is, yes, we've had a horrid, call it 7 years, but if you look at the last 3 years, we've been a very strong performing sector. But that's history. I'm looking going forward. And as Mvula spoke about, is that property, the fundamental building blocks of the return is your initial yield plus growth, because unlike bonds, we have growth in earnings. And coming out of the elections, going into a lower global interest rate environment, and also coming out of a very torrid Eskom impact on the country, never mind property in particular, which it was amplified. So we've got a lot in our favor. There are a lot of potential tailwinds that can push growth going forward. So I'm actually quite excited about property going forward. I think our total returns, very similar to Mvula, that I think it'll be around about, let's call it 14% in the medium to long term. And yeah, I'm actually quite positive. Well, that said, is that was my kind of introduction, highlight exactly what you asked. I do apologize, I went on a bit of a tangent there. So the question, what was it again?
So we are looking at your feelings around the ideal exposure to the property sector from a balanced mandate perspective.
Now I remember. Okay, so that's a great question, because on average in a balanced portfolio, guys are sitting with 2.5%. Yeah. And they believe it's appropriate because it's a small asset class and they're allowed to ignore it. you shouldn't be allowed because there's value added. If equity was small, you don't see any guys excluding completely. It's a balanced portfolio. This is a single asset class in its own identity. You have to include it. So 2.5% is definitely not appropriate considering the total return expectations of circa 14% with an interest rate environment going lower. We did some work in-house at Sesfikile with Anchor Capital. We built an efficient frontier. It said the allocation, hold your seats, should be circa 11.5%. We understand it is a very, relatively speaking, illiquid sector, so that's really pushing the envelope quite a bit. But 4-5% should be an appropriate allocation to listed property. And a lot of the, call it balance managers, they view it as equity. So they put it aside, they don't give it the credit. They say, well, it underperformed in the last few years, we can ignore it. You shouldn't be allowed to ignore it. It is a standalone asset class, and it should be circa 4 to 5% at this point in time.
Thanks, Evan. Mvula, we are focusing on the SA landscape today, but in reality, on a look-through basis, a significant percentage of property exposure is global. Through indirect exposure from counters like Hyprop, Growthpoint and Redefine, you have exposure to the UK, Eastern Europe, etc. With stronger e-commerce sales, again, maybe we've been reading too many overseas headlines, and high interest rates. Has the sector recovered to pre-COVID levels? How are the fundamentals looking globally, and are there specific regions where you see better opportunities?
Yeah, and again, thanks for the question, but again, to contextualize the landscape within the SA universe, you do allude to the fact that a lot of our assets are offshore. And I think if you look at where we come from, at least the last 5 years, I would argue that's been the more defensive region within the landscape of the SA listed property sector. Firstly, if you turn your eyes to Central Eastern Europe, where the bulk of the offshore assets within our universe are sitting, that region has actually been defensive. It's actually coming off a low base as well, and the macro landscape there in terms of GDP growth, wage growth, and then sales growth for Romania and Poland are actually quite strong relative to the rest of the Western Europe countries. So we like that region holistically from top down. And then if you look at the companies invested in those regions, the likes of your Napier Rock castles, the capital structures are quite defensive. LTVs well below sector averages, and then obviously covenant levels, they way far from breaching those covenant levels. So we generally like CE relative to the rest of developed Europe, and we think those are pockets of growth for the SA universe that will continue to support earnings. We come from a high inflation base, and again, if you look at the retail subsector, the retail subsector is traditionally a beneficiary of high inflation. The lease structures are such that there's indexation to them, and a lot of our companies have actually benefited from that, at least from the last 12 to 18 months, both passing through that indexation through to the tenants, which obviously has fed to earnings growth. So like I mentioned, Napier Rock Castle and Mass have actually benefited from that on an earnings level growth. If you look at the other regions, Growthpoint, like you mentioned, invested in Australia. They've got some office exposure there. We are still hesitant and have got our reservations of the office market in Australia. So we think that will continue to take some time to recover. And we've seen the impact that Growthpoint Australia has had on Growthpoint's overall performance. And then similarly, if you turn to the UK, I think it's quite mixed performance. I think a lot of the short-term performance for the companies invested there, the likes of your Hammersons and Capcos, have been more on a corporate action level, where recently Hammerson has disposed of the value retail portfolio, which has actually helped alleviate the capital structure. And I think they're in a position now to grow from off the space. So net would say we love CE, quite hesitant and reserved about exposure to Australia, and then we'd argue the UK is actually equally balanced.
Thanks, Mvula. Catalyst runs a flexible mandate, and you currently have roughly 42% offshore exposure. Talk us through, just on a high level, your global view, and where you are seeing more opportunities if we were to weigh the two up against each other, locally or globally.
Yeah, again, maybe if you go back to the previous conversation I had, the bulk of the offshore exposure within the South African universe is actually more on Western Europe and like I mentioned earlier on CE, if you look at our flex offering, we are looking at developed markets. So the exposure that you mentioned, the 42%, is actually heavily weighted to the developed markets, the likes of your US, Canada, Japan. And I think that exposure is more on the back of opportunity set. So if you look at the composition of the offshore benchmark and opportunity set there, we've got different subsectors there that have actually got, call it, different supply demand dynamics relative to your traditional commercial real estate, the likes of your retail, office, and industrial. So if I were to introduce data centers and towers, those dynamics and the growth fundamentals supporting the valuations, they are more attractive relative to what we have here in SA. So a lot of the exposure is actually more on the developed markets with exposure to, call it, AI type subsectors. And again, within the universe of offshore markets, I think the benefits of those subsectors to the real estate markets has been felt over the last 2 to 3 years in the developed markets, of which we didn't have in SA. But I mean, again, to Evan's point earlier on, we've turned net positive on the SA market. So the Flex product has got a different benchmark to some of our traditional benchmarks. So the offshore exposure is not a reflection of where we see value. It's more a function of the opportunity set within its own benchmark. So if you turn to our South African mandates, we are actually overweight SA. So we actually like SA, and we see more, call it, better growth prospects for the SA environment from a low base relative to the exposures that we have in our SA universe.
I'd just like to add in on that one as well. We also run flexible mandates, and we've been very much overweight South Africa, or the South African component, the South African index, for the last, I would say, 12 months. And to our benefit, it's been a good ride. And going forward, there's still a lot of growth drivers in South Africa. Now, coming through the elections, it's positive. Coming through the Eskom potential of a complete blackout, it's behind us. Now, there are a lot of positives going forward. But with that said, is that the US elections are all important, and how close is the Fed in cutting, and how considerable will their cuts be? So when you see more line of sight into that, well, that's when you want to tilt from SA to offshore. And Mvula's right, there's like a range of subsectors which have very different drivers and very much a different set of opportunities. But just because it's different doesn't mean it's better. So at the moment, we still overweight the SA because of the tailwinds that we are seeing. But when you get more clarity into what's going to happen with regards to the Fed and with the elections at hand, well, then we might tilt towards an overweight in the offshore. But as it stands now, SA has really been positive, and it's been a huge outperformer. I think the first half of the year, SA was up, call it circa 9.5%, whereas in the US or the global benchmark was probably slightly positive, less than 1%. It had run a little bit this month, but coming into that, call it, third quarter, it had really outperformed in SA by circa 9%.
Evan, thanks for that. You actually read my mind when you mentioned interest rates. We are moving closer to a rate cutting cycle, and we've discussed the long-term outlook, but what do you say to investors and advisors who are hesitant to invest in property, considering that significant recovery we have seen since the end of last year and the stronger recent performance?
The recovery started in beginning of November last year, and that was because of a global interest rate cut expectation, which didn't come to fruition as quickly as we thought. But the way we saw it at the end of last year, and it was call it a circa 20% rally, it was a recovery because the sector was oversold. Coming into this year, we believe the market did exactly as expected. You saw a tick over in the actual distributions that were paid that have come into the price. You've seen bond yields compress, as Mvula spoke about at the beginning of the year. They were circa, call it 11, just north of 11. They're now sitting, when I looked at the screen the last hour or so, at about 10.7. So all of that is very much explained. So the market's rally was initially a recovery. Yeah, it came in the form of expectation of rate cuts, but the truth of the matter is it was oversold. And it hasn't really overshot by any stretch. Both myself and Mvula are looking at, call it, circa 14%. That doesn't mean it's overbought by any stretch of the imagination. Over and above that, we saw a change in Reg 28. In the last 12 months, I think 18 months actually, there's been billions of assets, SA assets, that have been sold. Unfortunately, property was also in the crosshairs, and it's been oversold because guys have been taking money offshore. So we believe that that has actually created an oversold position. There is still value in our sector, 14%. And again, I'd like to be quite conservative on that number. If you expect the bond yields to exit at, call it circa 10.5%, if things get better, if the US starts cutting sooner and more aggressively, well, if you see our bond yields at 10%, you can get high teens, maybe even circa 20% in the next 12 months. I would invest on that premise. I think that 14% is a more conservative, more rational number, but definitely property is not overbought.
Gentlemen, that brings us to the end of our discussion. Thank you for valuable insights into the listed property sector. Any closing thoughts from your side, Mvula?
Yeah, I'll start off by saying we are constructive on SA property, both from a top and a bottom up. The sector is in a better position than where it's been the last 5 years. When we've seen improved ESG matrix across the sector, improved balance sheets, and now, like Evan is alluding to, potentially improved earning streams on the back of lower interest rate cuts. So we like the sector. I mean, we are specialists within the sector, so we are starting to see green shoots within the SA listed property market.
I agree with everything he said. I would like to put one more thing on the table. Your balance managers who are ignoring property, as allocators, you should put pressure on them. Why are they ignoring property? Are they doing the work, or is it just a waste of their time? Are they busy with other things? If they're a balanced manager, they should be looking at all the subsectors, and they should be giving property its dues. To have 2% property allocation as a balanced fund manager, it's just not appropriate, I don't believe. And they should explain why.
Gentlemen, thank you.
Thank you to our moderator and panel for the great insights. You most certainly provided us with some food for thought, particularly to those who were reticent to look at the listed property space. The fundamentals are certainly encouraging. Next, Tami Khoza, a portfolio manager at Equilibrium, will discuss the way forward now that the SA cabinet is in and share how the local model portfolios are positioned. Pleasure to have you join us today, Tami.
Thank you, Pat, and a very good day to our clients and stakeholders. We have titled today's presentation, The Cabinet is In. What now? Let's begin with a high-level overview of how the markets have performed. Globally, the broader market rally in equities continued on the same momentum as the previous quarter. This was, of course, mainly driven by revived hopes of a soft landing in dollar terms. Globally, still on these asset classes, bonds and property were under pressure. This was further exacerbated by, of course, the strengthening in the rand. If we glance our eye to the local asset classes, equities, bonds, and property experienced a significant rally owing to positive investor sentiment following the outcomes of the South African elections. Moving our discussion to our local model portfolios and how they have performed in response to what has transpired in the markets. During the quarter ended 30 June 2024, our income portfolio outperformed its benchmark, but came under pressure relative to the peer group. And this is owing to the residual effects of the side pocketing and the write-down of the MyPlan IP Enhanced Income Fund. All multi-asset portfolios delivered strong positive returns in the quarter, following a rally from local asset classes. Over their respective time horizons, the conservative, stable, and moderate portfolios remained ahead of their benchmarks as well as their peer groups. However, the relatively more aggressive portfolios, namely the moderate, the balanced, and the growth portfolios, came under pressure. If we look back in time, this was primarily due to the continued below average longer-term returns from local property and local equity, as well as the sell-off in global asset classes in 2022. Although the degree of underperformance has improved, most notably following last year's rally in global equity that has continued into 2024, coupled with the recent rally in local asset classes following the outcomes, of course, of the South African elections, as I had previously mentioned. Performance relative to the peers is very encouraging, with all the portfolios outperforming their respective ASISA peer groups. A similar theme applies to our unconstrained growth portfolio. In looking at our performance attribution, we will use the balanced portfolio as a proxy for our discussions. Strategic asset allocation was the highest contributor to performance, while tactical asset allocation and manager selection was light detractors. Pleasingly, over the last 12 months, the portfolio remained ahead of its benchmark and a CISA peer group. We will now discuss each aspect of our 12-month attribution in further detail. The graph on your screens illustrates the weighted realized return from each asset class over the last 12 months to 30 June 2024, relative, of course, to our long-term forward-looking expectations. Global equity continues to show a remarkable rebound due to, again, optimism on a soft landing in the US. Local asset classes, particularly SA bonds and SA property, have outperformed our long-term expectations over the last 12 months, following again from renewed optimism after the SA elections. You will recall that tactical asset allocation speaks to how we underweight, overweight, and take neutral positions on asset classes, depending on our short to medium-term views. Notably, our underweight position to SA cash was the largest contributor to performance, as we were underweight an asset class that didn't perform as well as the other asset classes during the quarter. However, our underweight position to global equity was the largest detractor from performance, as we were underweight an asset class that fared relatively well. Manager selection detracted marginally from performance. The significant contributors to performance, however, were our local equity managers, indicating the bullish nature of our local markets at this point in time, most notably during the month of June. Blue Alpha BCI Equity Fund, our quality manager, alongside Fairtree and FERT, our macro managers, were the largest contributors to performance. On the other hand, Catalyst SCI Global Property faced headwinds alongside Coronation Global Emerging Markets Flexible Fund, with the latter due to their overweight position in China, and lastly, Visio BCI Unconstrained Fixed Interest Fund, who was conservatively positioned in South African bonds. Looking forward at our TAA decisions for this quarter relative to the last quarter, the portfolios have benefited quite pleasingly from our slight overweight position in local equity. You will note that with global equity, we have retained a neutral position, bearing in mind the political risks in the build-up to the US elections. To our trusted clients and stakeholders, thank you very much for these formidable partnerships that you have formed with us. We hope that you have found this session to be informative, and we look forward to any questions that you might have. Thank you again, and speak soon.
Thank you, Tammy. Lastly, but most certainly not least, we now move to our colleagues in London. Please welcome Jade Coysh, a portfolio manager from our London office, who will discuss Equilibrium's global model portfolios and the opportunities in the global environment. Welcome, Jade.
Hi everyone, thanks so much for joining us today. Let's jump straight in. So the second quarter was a continuation of the everything rally that we've been experiencing over the last 18 months or so since October in 2022. But as you can see from this slide here, there is a clear winner in terms of who the outperformer is, and that is global equities. There are other asset classes that obviously are doing well. It's a pretty broad brush, but you can see that returns, including year to date and during Q2, have been dominated by global equities. And unsurprisingly, this has been driven by one theme, and that's artificial intelligence, as I'm sure you are all aware. You can see here from the green line that US semiconductors have performed phenomenally well, and this has meant that the global equity index performance has been very, very strong, and that performance is really dominated by the US mega cap tech space. Now, I think it's very important to acknowledge that these are fantastic companies. They are delivering superior earnings growth, and you can see from this chart here, it shows the 11 sectors of both the Russell 1000 and the Russell 2000 ranked by return on assets, indicating growth. And you can see that the technology sector is very much at the top of that ranking for 6 quarters in a row. And in fact, the technology sector has delivered around 11.5% over the past 6 quarters, which is just astounding. So we're not arguing that these are not fantastic companies. They certainly are. But just because they're delivering phenomenal growth today doesn't necessarily guarantee future returns. These companies will have to continue to deliver exceptional growth going forwards in order to justify the valuations that they are now trading on. So let's take a look at Tesla, not necessarily a direct artificial intelligence company or mega cap technology company, but it certainly is plugged into the artificial intelligence theme. And this week they came out with their quarterly results and they were slightly disappointing, or quite disappointing. And the share price fell by about 12% in just a couple of days. And what that says is that just a small miss, just a little bit of negative news can lead to a sharp fall in share price performance for some of these companies that are just priced for perfection, because that is what is expected of them. And you know, we're not finished with Q2 results yet. We are starting to see some wobbles in the performance of the Magnificent 7 stocks, but we haven't had results of all of those stocks yet. Some of them could still be absolutely fantastic, and we could see some more positive performance start to come through. Also, July is a very short-term time period, so it could be a little blip and then these companies could be back on track delivering strong returns. We don't know if it's going to be a negative theme or ongoing negativity from here. But it's to say that these companies are priced for perfection, and we are aware of that. But these companies remain dominant players within the global equity space and certainly within the global equities index. And so for active equity managers, it has been a difficult index to beat, with these companies generating such strong returns. And we are mindful of that. So within the Global Equities Fund, as I've mentioned before, we do have exposure to these companies, but we are underweight. So we participate in the rally, but if there is underperformance, our performance is not completely taken out by that. So despite top evaluations amongst this small subset of stocks, we do see value within other areas of the equities market. Even within US equities, we see value, for example, within the small cap space. This is something that I talked about in our last quarterly update. But we think that small caps are looking particularly attractive today. They're trading on depressed valuations, but there are some very strong companies, some very interesting companies, and we think that there is value to be had in this space. Additionally, another area that we think is interesting is the value space. Growth equities have outperformed value equities for quite some time, for many years, and today value equities are trading on, again, depressed valuations, even though there are many fundamentally sound companies within this subset of stocks. And just to point out that within the Global Equity Fund, we do have exposure to these themes. We have exposure to both value funds and also small cap funds. Although overall, the Global Equity Fund is style neutral, but there is a very small overweight to small and mid caps. Now, I've spent a lot of time talking about equities because that's what has dominated performance during the second quarter. But turning our attention to bonds, you can see here that yields have risen quite sharply during the second quarter, and that was as a result of quite sticky inflation. And this has meant that the performance of bond has been negative during the second quarter, and that is particularly the case for government bonds. With yields rising, we are thinking now that potentially this asset class is looking more attractive. So it's an area where we're considering if it's a good time to be adding to. So these are discussions that we are now having, although we haven't actually made that move as of yet. We are seeing some signs of potential rate cuts in the short term, with the softening of the labour market as denoted on this slide, and also with inflation sort of coming under control now. We're expecting that during the second half of this year, we are thinking that the interest rate cuts are going to start to come through globally, and the expectation is that this will have a beneficial knock-on effect to most asset classes. However, we are seeing signs of potential complacency within markets. This chart here shows that expected volatility is very low, and that's shown by the light blue line on this slide. And additionally, investment grade and high yield spreads relative to government bonds yields are particularly low at the moment, and this is shown by the red and the dark blue line on this slide. Essentially what this means is that investors don't require much additional yield for holding those riskier bonds, and the thought is that this is because they don't think that there's going to be an increase in defaults within the riskier bonds. However, debt levels are very high, obviously interest rates are very high, so there is a potential that both consumers and also corporates will start to struggle to pay off their debt, and we might start to see more defaults coming through. So this indicates, all in all, that there is complacency within markets. Additionally, this chart here shows that investors are bullish, and the risk aversion index is very, very low at the moment. This is despite the fact that inflation has been sticky up until very recently. Governments are faced with huge levels of debt at the moment, and there's rising geopolitical risks globally and various wars in the world. So we are seeing these risks, but investors are bullish and the risk aversion index is low. So all in all, we prefer to be a little bit more defensively positioned in the portfolios, even though if we do start to see these interest rate cuts coming through, this will be likely positive for markets. Now, turning our attention to portfolio performance, the Equilibrium, Cautious, Manage and Growth funds all generated positive absolute performance during the second quarter, but unfortunately underperformed their cash targets. Over a one-year basis and also over all of the recommended holding periods for the three portfolios, that's 3, 5 and 7 years respectively for the Cautious, Manage and Growth funds, the portfolios are in fact ahead of their cash targets and have generated very strong absolute performance. When we zoom out a little bit further, or a lot further, you can see over the longer term that all three portfolios are well ahead of their cash targets. So the portfolio's performance is denoted by the solid lines, and that's relative to the cash targets, which is those dotted lines. So longer term, we're very comfortable with the performance of the portfolios, although over the quarter it has been a more tricky environment. So focusing in on the quarter here, you can see that there's two key themes that have really driven performance, or really it's one that's really dominated. So again, it's coming back to this equity manager selection that has been a detractor, and that's because of that small cohort of stocks, the Magnificent Seven, the large cap US tech names that have done very, very well. And so on a relative basis, our active managers have struggled to keep up, and that's across all three of the portfolios. On the positive side, however, we have fixed income asset allocation, which has been additive to returns. So that slight underweight to fixed income has been positive for the portfolios, and that's because fixed income underperformed during the quarter. Now moving on to some asset class performance and individual fund performance, you can see here that although the portfolios underperformed during the second quarter, there are a lot of things that are working in the portfolio. So for example, the gold portfolio and the 91 gold portfolio has outperformed its index during the second quarter. And within the Dodge & Cox and Coronation aggregate bond portfolios, on the riskier end of the spectrum, the high yield and emerging market debt, a portion of the portfolios have outperformed. However, it's a little bit confusing. The Dodge & Cox overall performance shown on this slide is below that of the high yield index. However, that's because of the government bond portion of the portfolio within that fund that's underperformed the riskier end or the more riskier bonds. We'll also, within the global equity fund, there are some individual portfolios that have outperformed even the MSCI World Index. So for example, the Jennison Global Growth portfolio outperformed the MSCI World Index during the second quarter. And that's because the portfolio generally has an overweight to the AI theme. It has an overweight to some of the to some of the Magnificent Seven stocks, and therefore performance has been very strong. Also, the Robeco Quality portfolio has outperformed, and that's one of the quantitative portfolios within the global equity fund. But unfortunately, despite positive performance sort of coming through in the various different portfolios across the funds, there hasn't been enough to counter the negative performance from being underweight the Magnificent 7 stocks. This slide just shows individual fund performance of the underlying funds within the 3 portfolios. I won't dwell on it because I touched on it in the previous slide, but if you did want to go through any of the performance of these funds, please do get in touch. We're happy to provide additional detail. So turning our attention to our asset class views, so broadly our asset class views were unchanged in the second quarter compared to the first quarter. We remain underweight and have a slightly negative view on equities. Again, this is driven by the dominance of the US within the global equity index. So within the equity, our view on equities, we prefer to be underweight US equity because of that valuation argument. But then there are areas where we actually do see a little bit more value. So for example, we are overweight UK and Japanese equities where we have a positive view because of depressed valuations and the potential for those areas to generate outperformance going forwards. Within fixed income, we have a broadly neutral view. So again, we have individual ratings for the underlying assets within fixed income. But overall, we have a neutral view. And then we have alternatives, which for these portfolios is gold. We have an overweight rating there, and that's reflected within the portfolios. So although our views were unchanged during the second quarter in terms of asset allocation, there are a lot of things that we are now thinking about. So for example, we are reviewing the universe of infrastructure managers at the moment. This obviously takes a lot of time, but when we have selected a best-in-class infrastructure manager, we would like to add some infrastructure to these portfolios because we think it's a fantastic diversifier and sits very well alongside property, which we have exposure to across all 3 funds. And then we're also considering whether equities have further to run, given the stronger than expected economic data that we've seen over the last few months. But we are cautious because of some of those reasons that I mentioned around investor complacency. But it's something that we are discussing. Again, as I mentioned earlier, we're thinking about if it's time to buy more bonds given where yields are today and those rise in yields. And then lastly, we're also thinking about our gold exposure. So we generally hold gold as an event risk hedge within the portfolios, but the asset has increased in price significantly year to date. So we are thinking about whether gold is quite expensive now and whether that positioning should remain as is. So we haven't made any changes to the portfolios or our asset class views, but there are a lot of discussions happening in the background to see whether we should be making changes or whether it makes sense to continue as is. Now, you might be wondering why there hasn't been slightly more activity in the portfolios given all of the political change that's been going on. And of course, I'm talking about the many elections. In fact, there are 64 countries globally that expect to hold national elections during 2024, and this represents half of the global population. This includes key markets for us, including the US, the UK, South Africa, as I'm sure you're acutely aware, and also the European Union. And a potential change in government can have a knock-on effect to markets, but it's difficult to shift portfolios in anticipation of an election result because you have to guess what the outcome is going to be. And also with this many elections going on, and we have exposure to both developed and emerging market assets, which market or which election do we position for, and the right positioning for one might be the wrong positioning for another election. And so it's difficult to actually make changes based on election results and expectations alone. Additionally, history shows that elections actually only have a very short-term impact on markets. So it could be that we shift the portfolio in a certain way given our anticipated election result, but then it could just be a couple of weeks or a month, and then things can revert and we find ourselves in a difficult position where we're having to reverse those trades that we've already input. So as long-term investors, we choose to see this through this short-term noise, and we don't make calls on elections, and we don't make changes to portfolios as a result of elections. But of course, we are very aware of everything that is going on. We're always having these discussions, and we do make changes to portfolios if we identify interesting medium to long-term opportunities, but we wouldn't readjust the portfolio just based on election results alone. So that's all from me. Thank you very much for listening.
Thank you, Jade. That wraps up, ladies and gentlemen, our quarterly bulletin for the day. We know how valuable your time is and would like to thank you for supporting Equilibrium and for joining us today. We hope that you found this webinar insightful. Until the next quarter, goodbye.